today we have not just an extreme bubble in terms of asset valuations. We've had this sort of extremity in property bubbles in Japan and China. And obviously, we had very large tech related bubbles in the US in the 1920s, the 1960s, the 1990s, this last decade. The thing that's different about this time is that we've had 40 years of relatively unconstrained money printing because of the depeg from gold. This got taken to this illogical extreme, let's say, in the last several years of COVID. And then the government took that printed ammo and mailed it to people and delivered it to the private sector. So now the private sector is spending that money. So it breaks that link between spending being dependent on credit to now spending being dependent on money, both directly through fiscal transfers, but also indirectly because that money is propping up the asset bubble, which drives people's willingness to spend and their balance sheet ability to spend, which is why savings rates are plummeting. So that's the issue. That disconnect means that market cap to GDP globally, but particularly in the US, is massive. It's this hyper financialization of the economy has happened for 40 years and then in this sort of blow off top in the last several years. And so because of that, two things have happened. One is the supply of money is now completely disconnected from the price of money. Interest rates were zero for a long time. They increased the supply regardless. The supply of money expanded, provided balance sheet for these financial assets, which are now very high relative to GDP. And so people are looking at correlations that aren't really causal. This was a common narrative in the market. The bubble in growth stocks is a function of interest rates. Okay, no, it's not really. Really what happened was there's a lot of money printing. The Fed's buying bonds, so it's supporting bond prices. It's displacing investors who previously owned bonds, who are now going into other assets and propping those asset prices up. So it looks like bubble stocks are very much a function of yields, but actually both things, yields, i.e. bond prices, and stock prices are a function of this huge amount of money that's being injected. The Fed now has to choose. They can't nuke this bubble because it's so big relative to GDP that if they did, it would just be catastrophic in terms of the balance sheet fallout. And so on the one hand, trying to choke off this high nominal income growth, nominal spending growth, inflationary cycle we are in. But then when they do that by contracting liquidity, they impact asset prices. Like last year, you saw the worst bond drawdown since the 1860s. And so like people who hold bonds are not equipped for that. They weren't expecting it. They're not capitalized. They're levered players and so on. And so then the Fed freaks out about, oh my God, like systemic risk, and we got to pivot back. And so in 2023, there was really two Fed pivots. One was the over response to what they perceive to be a systemic banking crisis. Bear in mind, these are people who see no cost to printing. They've been able to print and spend for 40 years. It hasn't created a lot of inflation because of offsetting globalization and the dynamics there, which provided supply that met the demand by all of the increase in money and credit over that 40-year period. And so they kind of have this Pavlovian response to any market weakness, particularly in the sovereign bond market. And it's not just the Fed that did that. The BOE did it too when pensions were selling gilts because of the drawdown in gilt prices. And so they pivot back from late March of 2023 through to May, injected almost like a QE1 sized amount of money. So you saw base reserves in the banking system going from contracting in 2022 because of quantitative tightening to expanding again in 2023. And then even though there was no banking crisis, if had it happened, provided an offsetting credit crunch, it didn't happen. And so you end up in this world where you got a lot of money printing, you got a lot of fiscal stimulus, fiscal deficit blew out from 5 to 8% of GDP last year. You have really no impact from rate hikes because there wasn't really a lot of credit going on in this cycle. If you have an entirely fixed rate stock of debt, it's very hard for that rate hiking cycle to actually flow through to that debt and squeeze people's incomes, which would then generate some sort of reduction in real spending. And any reduction there was in credit was more than offset by the fiscal expansion. So that's the issue that the Fed is facing. And that happened in the first half of the year. And then when you look at the market action, when did the new narrative in the tech bubble, the AI stuff, Mag 7, all this stuff, when did that really disconnect from broad stocks? During that exact same period, during late March to early May, that whole rally extended, and that those sort of concentrated stocks did very well because they received a lot of the retail inflow that was down the chain from the Fed having printed a whole bunch. And it just continued through the end of the year, although that wasn't really the Fed's choice. That was more the government realizes they're issuing 8% of GDP. There's no demand for the bonds that they're trying to place. And so around September, they decide we're going to issue bills. This is Brazil style stuff. We're going to finance at the very short end because no one wants our term debt. And instead of actually fiscally contracting and being somewhat responsible, we're just going to finance in a way that doesn't actually crowd out any other assets from balance sheets, doesn't require people wanting to actually buy our bonds. And so this was sort of a wonky mechanical thing. But when they issued a lot of bills, what happened was money market mutual funds, which have a lot of cash as a byproduct of QE, had parked that cash in the Fed's reverse repo facility. They're earning 5.3 in that facility. Those guys pretty much want to buy bills. They want to buy all the bills that exist. They want to term match their CDs or their inflows with the assets that they put that money into. And so when the government started to shrink the bill stock, a lot of that money went into the reverse repo. When the government decided to throw out bills like confetti because the bond market couldn't really handle the supply, all of that money came out of the Fed's reverse repo and then expanded bank reserves in a second sort of pivot. It wasn't really the Fed's choice. It was more just a natural wonkiness in terms of how the monetary pipes were working. But that's why we got $500 billion of base money expansion last year, even though quantitative tightening was ostensibly going on the entire time.
Well, damn, Whitney. All right. There's like five different ways to go here. That was great. There's a couple comments you made. One, thinking about the Fed and thinking about asset price levels. That's not something they, at least to my knowledge, they explicitly target. But is that something you think is front of mind for them? It seems like the narrative is inflation's conquered. It's back down to mellow levels. Maybe talk a little bit about inflation, about the Fed, and kind of what their mandate is, what they're thinking about.
So there's a few things. So ostensibly, the Fed's mandate is employment and inflation. The reality is they're human beings. They're no different from any other market participant in that they're using frameworks and heuristics that have been based on recent history and have worked in recent history. And they're talking about very academic things like the concept of a neutral interest rate. To me, that makes absolutely no sense because the interest rate that is neutral at any point in time is going to be a function of how much debt there is, how much of that debt is floating rate, how much recent debt was taken on. It's a constantly dynamic concept. So the point is, I think they're trying to steer policy using things that are grounded in somewhat academic frameworks, when what we're dealing with is a situation which emerging markets have seen very many times, which is this issue of how do you actually know when your own policy is restrictive enough or not restrictive enough, netting it with what the government is doing as a way to kind of control your end targets? The problem the Fed has now is that their inflation target, which is essentially the binding constraint at the moment, it eased up last year for reasons we can talk about, which had nothing to do with supply or falling demand in the US, which is interesting because people are confused about why there has been this transitory slowdown in inflation, but it's very logical. They're using these backward-looking frameworks, and they're saying, look, we don't really know what's going on, but it looks like inflation's come down and maybe there's space to ease. And because they're fighting the last battle, they're somewhat like PTSD from the GFC and saying, look, we don't want a banking crisis. So everyone's over-focused on the issues at the banks, even though the banks are incredibly healthy. That's why they were so quick to react to what was going on with really what were three really badly managed banks that had particular levered exposures to the VC cycle and to the bubble that we've just come out of, rather than being indicative of broad systemic banking issues. And so the Fed showed their bias in that moment. They showed that they're basically playing this whack-a-mole game where, okay, when inflation looks problematic, they go over here and they tighten and they try to suck out liquidity and deal with the inflation problem. But then by doing so, they suck out some of the liquidity that they then injected previously, which held up asset prices. So naturally, asset prices, that disconnect they created starts to close. That's a natural consequence. They go back over to that and say, oh my God, this is going to create a problem given how levered balance sheets are and so on. And so the problem is that the amount of liquidity that should be in the system that is consistent with getting the inflation situation actually durably under control is too small relative to the amount of liquidity that's needed to keep the asset bubble either elevated or deflating in a really manageable glide path. And so that's why you're getting essentially sideways asset moves. So if you think about, okay, big rally in bubble stocks through early Feb 2021, then the broader stock market, November 2021, big drawdown. Okay, then the Fed reacts and pivots back, injects money, big rally. This is where we are now. In that rally, injecting more liquidity, then adds more stimulus, particularly with the fiscal kicker, to the growth and spending cycle we're in and the inflation constraints we have. Then they got to pivot back over there and deal with that. And so they're just flailing around like one of those balloon guys outside of a car dealership. They don't know what's going to happen. They have no framework to even explain what's going on now. And so they're just very reactive in the same way a lot of market participants are reactive. The problem with that is they don't really have a good way to calibrate what they're doing. Why is it that the market is currently priced for, even after the inflation print we just saw, which, I mean, there's a lot of reasons why, and we can go into them, why inflation is a problem, still is a problem, will be particularly a problem in the US relative to everywhere else. But the recent prints are showing that. They've been showing it really since July of last year. The market is still pricing like 80 bips of cuts this year. Why is that the case? Employment is very tight. The economy's running very hot, super above potential, particularly when global economies are running with a lot of slack. They've just come out of recessions. They're the sort of opposite. They haven't been the economies that have done well in the last cycle. The US has. So it came into this running hot and is now running even hotter as a consequence of not having the recession that all those other countries just went through. And that's basically the problem. So we're here in this situation where the markets are saying, in the past 20 years, there's been big nominal rate hike cycles. That's created recessions. Then there's easings. We're going to price that easing. We're going to misprice that recession, which never happened. And for some reason, the markets seem to expect rate cuts now, which from my perspective, it doesn't make any sense, right? Because the assets are high, the economy's doing well, inflation is accelerating, the economy's reaccelerating. There's nothing to respond to in terms of the need to ease policy. And yet that is still what's priced.